Hey, everybody. Welcome to the morning market briefing, Thursday, January 19th, 2023. Hope everybody is doing well out there. Let us know quickly if the audio is not working. We think we tested it out at the end of the show yesterday, so we should be in good shape, but I appreciate your patience with that yesterday. Opening up, let's talk about Jim Bullard. He really took it upon himself to push the market down yesterday. We were sitting nicely in positive territory, and he spoke and really drove it down, Tom. Are you surprised by that? I feel like that's kind of his game.
Yeah, I mean, he didn't say anything that we didn't say he was going to say yesterday. He's been pretty adamant and along the party line with the Fed saying that they're going to raise rates somewhere between 5.25% and 5.5%, which is pretty much what he said. He did, though. I think the shocking piece was that he appeared to be in favor of 50 basis points on the first. I'm going to cough. And so I think that was a surprise to people. And he basically said, we've got to get tighter on interest rate policy, on monetary policy in 2023. We did hear from a number of other Fed talking heads. We heard from Lori Logan, from Patrick Harker. We heard from Loretta Mester, and it's sort of a mixed bag. Almost all of them are in the camp of we need to be at least at 5%, which I think the market is was kind of leaning away from, even though they've continued to say it. And then, most of them, Logan, Harker, are in the 25 basis points and very slow approach. You might have a little bit more hawkishness with Bullard and Loretta Mester. But I think that we're basically in a position now where they're going to continue to get more restrictive. To what extent that actually is hard to say. But my guess in base case kind of this whole year has been, I think we'll get at least 50 basis points, if not 75 this year. What the pace of that looks like, I'm not quite sure. But right now, I'd say 25 basis points each meeting, at least for the next three meetings. And I think that after that, anyone's guess as to what the Fed does.
Yeah, it's interesting that I feel like we've seen the market at large misread the Fed to an extent of ignorance really twice. I mean, we had the one period in September and October where they started talking about, hey, maybe we're going to get a pivot, even though there was nothing really indicating that that was the Fed's intention. Now we see the Fed, I feel like pretty clearly messaging that we've done a lot of the work, but the job is not finished. So we need to continue to be restrictive, and the market seems to think like, oh, they don't really mean it.
Yeah.
And so there's still some opportunity, I think, for some pain and some bleed out in equities, and we saw that a little bit yesterday.
Yeah, and I think the other piece of that though is, we're at this present time we're kind of haggling over 25 or 50 basis points until they finish. Versus, I mean, they raised by 400 basis points last year.
Yeah. Well, we did more than they're anticipating this year, multiple times, in a row.
So again, I just don't think it really makes a huge is a huge deal. I think the Fed is going to react slower. Bullard said it yesterday. He said just history doesn't support the fact that inflation goes down, even though it's weird because the Fed was very adamant that inflation was transitory. But now apparently the transitory is never a potential. But I think that inflation is coming down. We'll see some of that in the earnings reports that we saw this morning. But the problem with the Fed is the jobs market remains unbelievably tight. In fact, we just got a new initial jobless claims number that was even lower than we thought. And this is with Amazon laying off people, all these anecdotal things that we talked about at the macro presentation. You hear all these anecdotes, but when you actually look at the real data, in aggregate, people are not really losing their jobs that much, and hiring continues to be robust.
And I know one of the things we talked about on the initial jobless claims, there's a lot of noise in that, but we talked about even looking at, the 8 or 10 week trend line on initial jobless claims. I mean, we started talking about that back in June. Hey, this is really something to keep an eye on. And I mean, there's just never been a period where over that prolonged period, you've said, wow, this is really concerning as it relates to the job. I mean, we've just never gotten anywhere close to that level. And we're continuing to see real strength in the labor market.
Yep.
And which, again, I don't mean to say that as if it's a bad thing, but it does underscore some of the things we talked about, I think, in the macro as it relates to a soft landing. And Even Bullard saying, the prospects for a soft landing have improved markedly. I don't disagree. I'm surprised. I'm very surprised that the Fed was able to drag their feet for so long and then be incredibly aggressive. And here we are, but maybe that speaks a little bit more to just the underlying strength of the economy as a whole going into this period. And maybe it speaks a little more also to kind of the pocketed nature of the inflation where, it was high everywhere, but there were some extenuating circumstances on large cross sections of the CPI print.
Yeah.
Discover Financial reported earnings down about 7.5%. Ben, what are they getting punished for?
Yeah, I mean, the results were good and their guidance was good until they got to this number. So charge-offs, the amount of receivables essentially that they are just writing off, were about 1.8% in 2022, which was a little bit on the low end of what they've experienced historically. Historically, they've been in the low 2% range. There was a couple of years, 2018, 2019, 2020, when they're between 3 and 3.4%, but generally in the low 2s. So 1.8% was a good number. However, they are guiding to charge-off rates for the full year in 2023 of 3.5 to 3.9%, which would be the highest charge-off rate since 2011 in the aftermath of the global financial crisis. And if you chart the path from 1.8, from an average of 1.8 to an average of 3.7, call it at the midpoint, you're probably going to end the year well above 4%, which was almost double the charge-off rates they normally see. Now, they were just explaining this on the conference call before we walked over here, and they said this is because they had a record number of new card signups, and that they're in this first or second year of that vintage, which typically you open a credit card account, you pay it for a year, and then if you're going to stop paying the credit card account, people stop paying in the second year. And so they're saying basically a lot of that seasoning, and not just what they're seeing over in all in the macro. But I tell you what, if we do get a deterioration in the macro and these are seasoning at the same time, you're building up a very good wet paper bag for Discover, and all the shorts will be on it. I mean, it will be the easiest short in the world if this thing really deteriorates more. I'm not calling for that, but that's what the market's reacting, and I think it's reacting appropriately to it this morning. Stock's down 8%.
Procter & Gamble down about 2.5%. We talked a little bit in the macro presentation about the impact of pricing and what different publicly traded companies were saying at the ICR conference that you all attended last week. Procter seems completely reliant on pricing at this juncture.
Yeah, it's a bit unfortunate. They actually raised their guidance for the full year, but they're having fewer headwinds. Their pricing is coming in higher than expected, but their volume is really dropping off. Their organic volume was down 6%. In grooming, volume was down 8%. They said they attributed that to inventory reductions on appliances at retailers and market contraction. Really, the only thing that bailed them out was a stronger flu season. And even there, they still lost volume on a year-over-year basis, only made it up through pricing. And with Procter, it gets very tough because you go from pricing growth. Right now, they're comping over a period of 3% pricing growth. Next quarter will be 5%. The quarter after that, it'll be 8%, and then 9%, and then 10%. And so you're having to what they call comp the comp. You're having to comp over periods where they started to raise prices very aggressively, and they're not going to be able to do that this year. We're already seeing more price elasticity. Their volume was down 6% in the quarter. They're not going to have the ability to raise prices like they were. And for a company that's reliant on that, it does potentially create some issues for them going into the end of this fiscal year, which ends in June, and then also into next fiscal year, which will go from July of this year through June of the following year. And you could probably be set up for a couple of years of dead money in Procter & Gamble.
Bank of America with interesting data on big ticket purchase plans. We've talked about this before, I know on the call, probably in macro presentations in the past. But despite some of the uncertainty as it relates to inflation, the economy as a whole, the job market, some of these anecdotal data points that we've gotten, American people are pretty interested in big tickets purchases. Those planning to start a family or have a new baby significantly higher than the reading a year ago, and really the highest we've seen at any point in the last 12 months. People a little bit more interested in a new vehicle purchase than they have been. But what's really interesting, I think, is actually the interest in a new home. Seems to be just kind of spiking. Ben, what are you seeing from the trends of how people are thinking about what to do with their capital?
Yeah, I mean, new home indications of plans to purchase a new home, an apartment, or condo in the next 12 months are the highest they've been in the last 24 months. With rates where they are, with prices where they are, and you start to get a little bit of a decline in mortgage rates, and you're going to have people jumping in back to the housing market, which really kind of speaks to the fact that we don't think there's going to be a massive house price collapse. We do think that we need more inventory. I mean, there's 27% of the people surveyed in this survey who want to buy a new home. And at the prices they are, at the mortgage rates, which are currently on offer, that's going to be very challenging to do. I think the new baby is interesting. New vehicles purchases are interesting. And what you're seeing essentially is people are going from spending on just live in the moment, YOLO, to more, okay, I'm going to think about what I'm spending a little bit more. You're seeing a shift in intention from casual and athletic apparel to business and formal apparel. And that's at the low end of incomes. Higher end of incomes, you're seeing that as well, but especially at the lower end of incomes. We saw that at ICR conference as well. You're seeing interest in travel continue, but also home improvement and renovations. That's the second most popular category among higher income people. Seeing some home furnishings. So that there are things where people actually want to invest in what does their life look over the next 5-10 years versus what can satisfy my online shopping addiction today. Online shopping, interestingly, the bottom category for higher income earners, and the second bottom category for lower income earners. So people are really trying to move away from online shopping into more things that are sticky.
The home thing is incredibly interesting to me because I think you can make, I don't know, and this may just be my household amount. Tom, you've got kids. I don't know how much of the decision to have a child really was actually an economic decision. I think I just had this general cloud of like, yeah, it's going to cost money to have a kid. But was I sitting out, and getting out a spreadsheet and figuring out what it was going to cost, year one and then long term? Like, no, not really. The car thing makes a little bit of sense because we've seen some relief on auto pricing. And you think of all the people that maybe have put off car purchases, that being relatively elevated year over year makes some sense. But the home purchase is probably the single purchase that people actually think about through an economic lens the most. And so for them to see where prices are and know where interest rates are, that's wild to me. I mean, I think if anything, I wonder if that number is muted by the economic situation. And it makes you think, hey, if we get a little bit of rate relief, not only are we going to have a nice floor on housing prices, like you could see those start to reaccelerate again.
Yeah, I mean, in my experience, I definitely waited until I felt that I was financially capable of
Well, and the health insurance is a big piece too. You got to be employed.
Yeah, I mean, as an old dad, I definitely was like, man, we can't do this until we're in a position where this life is not going to suck for this kid.
No, and I agree with that. I don't want to say
a lot of people think that way.
Yeah, I don't want to say I didn't think about it, but it certainly wasn't like, well, where are interest rates right now?
Yeah.
The way I would be with a home purchase.
I mean, I definitely was that way, but that's this is how I am. I'm very cheap, but also I would say that back in 2019, Matt and I went to a CFA fixed income conference, and there's a guy up there talking about the housing market. And he was saying that there's nothing more bullish for the economy than people wanting to buy houses and wanting to have kids. So if that's one takeaway, because you're locked in. You buy a house, you're committed. You have a kid, you're committed. So that's a long-term outlook where you think that you're going to be okay for the foreseeable future.
Yeah.
Or you're an idiot. So it's one or the other. There are a lot of people who have kids and they can't afford them and they shouldn't have them. And
it's either really good or really bad.
Yeah.
Good for the economy, bad for society.
We'll see how it goes.
Yeah. Well, I can't wait to revisit this call in 18 years.
Yeah.
See how this works out for everybody. We'll wrap it up there. We'll be back tomorrow morning at 8:30 and we'll talk to you soon.